Do you want to know how to become a smarter investor and make better financial decisions? If you're not paying attention to the cash flow statement, you are missing out on critical information that could make or break your investments.
That's right. The cash flow statement might not sound like the most exciting thing in the world, but it's arguably the most important of all financial statements. Before I became a financial auditor, I had no idea how to read it. But once I learned, everything clicked.
In this video, we'll cover the 3 main sections of the cash flow statement and some essential tips to read it for the first time. So let's dive in.
Hi there, I'm Bertrand and I'm the founder of App Economy Insights.
And I'm Stephanie, tech veteran, engineer, and creator. There are 3 primary financial statements that every business owner or investor should know. The income statement, which shows a company's profit or loss, or P&L for short. The balance sheet, which shows what a company owns and owes. The cash flow statement, which shows the cash inflows and the outflows.
So these 3 documents are like the holy trinity of finance, and understanding them is crucial to making informed decisions about a company.
We'll have videos on each financial statement. Today, we'll discuss the cash flow statement. Now, before we start, it's important to highlight a common misconception. Cash and profit are not the same things.
Great point. Cash is a company's money on hand, while profit is calculated by subtracting all expenses from revenue. A company can have positive cash flow, but be unprofitable, and vice versa.
Let's break it down further. Revenue and expenses are not always timed in line with cash inflows and outflows because they're recorded on an accrual basis.
For example, a company might sell goods on credit. In this case, the revenue is recorded when the goods are sold, but the cash may be received later.
On the other hand, a company may purchase goods on credit and pay later. In this case, the expenses will be recorded when the goods are received, but cash is paid out later.
In addition, some expenses like depreciation, amortization, and deferred tax are non-cash expenses. They reduce the company's net profit, but don't involve any cash outflows at the time of recording.
So a cash flow statement shows the actual cash coming in and going out, while an income statement shows the company's profits and losses. Now that we've clarified the difference, let's dive into the cash flow statement. It's split into 3 sections: operating, investing, and financing activities. Let's use Apple, the largest company in the world, as an example.
In a previous video, we covered Apple's income statement, showing revenue minus expenses and how we end up with net profit or net income. It's in the top right. Well, the cash flow statement starts where the income statement ends, with the net income. If we switch to the cash flow statement, you can see the net income as a starting point in the top left of the chart.
So let's cover the first section, which is the cash from operating activities. We start from the net income and we add back the non-cash transactions from everyday operations to calculate the operating cash flow.
Operating activities show the cash generated or used in the company's core business operations. It's the heart of the cash flow statement.
The operating cash flow is the most important part of the statement to appreciate how a company is generating cash from its day-to-day operations. A positive operating cash flow is a good sign, but we need to examine it closely.
That's right. We need to cover 2 key non-cash expenses that are added back in the calculation of the operating cash flow. First, we have stock-based compensation, or SBC for short, which is a type of benefit that gives employees the right to acquire company stock at a discounted price or for free. It's a personal compensation expense with no cash leaving the bank.
Second is depreciation and amortization, which are non-cash expenses tied to long-term assets. These big-ticket items were bought previously, so the cash was already spent. As discussed in our balance sheet video, the value of long-term assets is gradually reduced over their useful life.
Overall, when evaluating a company's profitability, it's important to focus on net income. But when evaluating its ability to meet financial obligations over time, the operating cash flow is a better indicator. So before we move on to the 2 other sections, if you like this video, remember to subscribe to our channel and be the first to catch our latest weekly videos as they go live. This will help us be discovered and bring more educational content to you.
Let's move on to the cash from investing activities section, which shows the cash a company uses to invest in future growth. This reflects cash spent or received from investments like buying or selling assets or mergers and acquisitions. It's important to understand that a negative cash flow in this section isn't necessarily bad. It could mean that the company is investing in its growth or putting money to work.
The investing activities are where we can identify capital expenditures, or CapEx for short, which are cash outflows that a company incurs to acquire or upgrade long-term assets. Lastly, we have the cash from financing activities, which shows the cash a company is raising from investors or borrowing from lenders. In the case of Apple, they are using the money they generated from operations to buy back Apple stock on the open market. It's a tax-efficient way to return cash to shareholders. We discussed this in our balance sheet video.
The financing activities are where we can analyze a company's debt and equity financing activities, such as issuance or repayment of debt, issuance or repurchase of equity, and dividend payments. It's essential to analyze this section to see how the company is financing its operations and whether it relies heavily on debt or equity.
Perfect. So here is a chart to summarize everything we just learned. The cash flow statement starts with the net income from the P&L. We add back the non-cash charges and other non-cash fluctuations. We end up with cash from operations.
And from there, we add the cash from investing and financing activities to end up with the net cash flow for the period. That's the net increase or decrease in cash in the company's bank account for the period.
Now, you should have a solid understanding of how to read a cash flow statement. So in our next video, we'll cover how to analyze it like a pro. That's where you'll discover the key ratios and metrics to watch, and you'll learn how to connect the dots with the other financial statements.
So see you there.